We argue that once the U.S. stock market breaks, the money will flow like blood. Okay, it will go somewhere else. It always does. You go back and look at history for the last 100 years of major stock market declines, you could find something where it was a better place to be. Not just better, but good place to be. And that's monetary metals, gold. Sometimes, in fact, many times, T-bonds have also been a good place to be. You go back and look at the dot-com top through 2002 low, bonds did well, gold did well. Gold did well for 11 years then, from 2000 to 2011. 2007 top to the 2009 bear market low. Gold did well, with the exception of 1 month in there, and T-bonds did well. This time around, it's going to be different. This time around, a lot of people know we have a government debt crisis, and it can't just be wished away. New president can't wave a wand and it goes away. It will cause hemorrhaging. However, we see technically the potential that once the stock market starts to crack in a way that upsets major asset managers and smart investors, the money will begin to flow, and it'll go to the two traditional safe places, gold and related, and T-bonds. However, any T-bond rally you see, while it could be enjoyable for, let's say, a quarter of a year, maybe several months, as money flows out of stocks into T-bonds, it's not going to last. In other words, the guys who analyze T-bonds as a major bear trend, higher rates, are correct. The problem is we see the potential for a counter-trend rally in T-bonds that could upset those people's notions. Not that their notions are wrong, just that there's going to be a counter-trend rally. I think there's a good potential for that. However, don't confuse that with gold as being a viable alternative. So we think that the key now for gold and the key now for the T-bond market is the breakage in the stock market. So if you're in gold, look at the stock market, okay? Because when it cracks, the blood's going to flow, and it'll flow quickly. We have a massive historic bubble in the stock market in the U.S. by all metrics, duration of time, percentage gains, et cetera, et cetera. There's only two other markets in the world that compare, and that's the Sensex in India and the Nikkei in Japan. Europe doesn't compare. China is certainly not a bubble. It's barely, not even twice, I don't think, what the price low was in 2009. You know, when they made a low coincident with us, they're only double. We're like 8 to 9-fold in the S&P and 18-fold in the NASDAQ. So, but when it breaks, the money will flow, and it will flow into those categories. And if your objective measure just of simple price, you can see, hey, it's been flowing this year. Why? Because gold and silver are up as much as the stock market. Nobody's touting that, but because we get pullbacks constantly in gold and silver. And yet, year to date, and possibly in 3 more trading days, they'll be up more than gold, than the S&P and the NASDAQ year to date. So money is already beginning to flow, but it'll begin to flow more noticeably and in great volume once you punch a hole in the stock market. And we do see the technical triggers for that literally a couple % below where you're trading right now. Once you get into next quarter, our numbers shift, meaning the metrics by which we measure momentum of, let's say, the S&P or the NASDAQ or stocks or sectors shifts. Because why? When you have a moving average against which you're oscillating a market, that moving average changes. So it changes over time. So your yardstick is changing. And as it goes up along with the market, tailing the market underneath, suddenly you could get a jolt there where you get an upward movement in 3-quarter average, for example, which is a long-term metric. 3-quarter moving average is about comparable to a 200-day average, okay? And next quarter, that average is going to jump up for the S&P and the NASDAQ. The problem is when you plot a momentum chart of the S&P or NASDAQ, forget the price. Price looks lovely. It always does at tops. But the momentum structure is bleeding obvious. A kid with a crayon and a ruler could plot it. It's so clear. And it's literally, you'll break that structure. And this, I'm talking about trend structures that are definable by 2 years of basically horizontal action. While price is doing this, momentum is banging on the same shallow floor. And once you pierce that, momentum says it's over. And it's, like I said, a couple % below where you're trading right now. I don't know that the market has to crash, the stock market. That is a rare event in bear markets in the first place. So I know a lot of gold bugs are panicked about the notion, well, if the stock market goes down, gold will go down. Well, it's actually not true. Historically, it's not true. As I said, like 100 years, look at the 29 to 32 bear market in the stock market. There was no gold trading then, but you could buy Home State Gold Mine. It went up 1,000%. Well, the stock market was decimated. And it took the stock market another decade and a half just to get back to the price high it had in 29. And during that time, gold was a better place to be. Mid-70s, gold was a better place to be. It went to its high in 1975 while the stock market was imploding. Okay, the 2000 dot-com top. You had an 82% collapse in the dot-com sector, NASDAQ 100. Gold went up during that time and continued up for another 10 years. 2007, stocks peaked when they started cutting rates. September, October 2007, the Fed cut rates for the first time in a couple of years. That was the top. They cut rates all the way down. Gold went up. Okay, with some exceptions, a month here and there, but basically the trend was opposite. So I don't think that's going to occur. Yes, gold could go up if the stocks continue up, but we are highly, highly doubtful that stocks are going to make it probably through January or February even, in terms of jolting the market enough to where people say, my gosh, what happened? It takes a bit to do that. Now for momentum, it doesn't take much to break the backbone. But for price, it takes, you get a 10, 15, 20% drop. Now, the funny thing about that is there are a lot of skeptics out there of the stock market, sober analysts who look back at history and look at various valuation metrics and so forth and say, this is a bit done, boys. This is way overdone. And they're calling for a, quote, correction. Well, correction's what, 20%, right? Like that's the standard. Hey, you don't want to go 20%. You go 20, you're going to go 50 or more. Okay, because why we can see by momentum structures below the market, particularly annual momentum, when we measure not just versus 3-quarter average, but a 3-year average. You can't drop 20%, you'll blow it. You blow quarterly first, and then you'll blow annual. So you cannot have a correction in the stock market. If you're a bull, you don't want it to even hiccup at this point. If it even hiccups, it's going to break its backbone, and the money will flow into gold. And we can understand the fundamental underneath that. It's not so much whether the Fed cuts rates or not. That's not an issue. In fact, there's plenty of times in the past when you've had a bad stock market, the Fed's been raising rates, like the late 1970s, for example. Rates were going through the roof. So did gold. So what really matters is the monetary policy and the aggressiveness of monetary expansion, Fed balance sheet, and panic on the part of the central banks, because then they put the pedal to the floor. One aspect of that might be rate cuts, but that's really not the essential. The essential is the monetary expansion. I suggest to your listeners, go to the Federal Reserve St. Louis site and look up M2, and you'll see a chart. And there was a pause and a dip a year or so ago. It's accelerating rapidly right now. Monetary expansion is back into full throttle for the last year, going vertical again. So they're concerned about something, and if you rattle their cage, they won't show it in their face and in their press conferences, but they'll do it in policy, and that's what drives gold ultimately: the degradation of the money unit. We've had for the last 100 years, ever since the Fed's been around, meaning an entity that has the legal monopoly over the quantity and the pricing of money. Okay, what's money? Well, it's the most essential commodity between you and me or any businessman, somebody manufacturing something in this part of the world and selling it over here. The medium of transaction is unit of money. Yens, euros, etc., dollars. And as long as those units of money are degrading in real buying power, ongoing, and they are. Meaning, forget what the dollar looks like versus the yen or the euro. Those things can fluctuate. The real issue is the total degradation of the money units. Well, the dollar, you look back at the M2 chart that I mentioned, go back 50 years, take any 10-year segment of that and check the numbers and see how much it grew. Basically almost doubled every decade, the quantity. Right now, it's even a faster pace. Well, if something doubles in quantity, it reduces its real value by about 50%. So if you bought a stock at $10 and 10 years later it's 20, you're not really making any money. Okay. What did your parents pay for a house? What did your granddad pay for a house? You would consider pocket change. Okay. What happened? House prices go up? No, the value of the money unit collapsed ongoing. That's what drives gold ultimately. And when the central banks panic because this key asset category breaks, and by the way, all the data points that people like to look at, like unemployment or factory output, and all these various economic data points that the Fed has now said, don't forget, guys, this is our other mandate, not just quote inflation, but the economy, unemployment. And as those numbers get bad, they shift fully to that mandate. When do those numbers get bad? Go back and look at previous bull market peaks in the stock market. It's rare when you see a collapse in the economic data points and then the stock market goes down. It's the other way around. The stock market peaks, you might have had some softening a little bit, but the real drop in those numbers or the negative shift in those economic data points occurs after the stock market has begun to implode.